Hi everyone, and welcome back to our channel, The Money Blueprint. I'm your host Michael, and I'm thrilled you're joining me today. In today's video, we're taking a deep dive into a crucial topic, understanding precisely how the various factors we've touched upon in our previous discussions directly impact the true value and potential of a cryptocurrency. It's about connecting the dots between theory and real-world market behavior. If you have not yet seen my last two videos in this series, I highly recommend taking a few minutes to watch those first. They lay the groundwork for what we're about to explore and will definitely help bring you up to speed, ensuring you get the most out of today's session. Today, our mission is to meticulously break down the critical elements that contribute to a crypto's valuation. We'll start with the bedrock of fundamental research, move through the often turbulent waters of market dynamics, and then dissect the underlying technology that powers these digital assets. Furthermore, we'll explore the intricate world of tokenomics, understand the powerful influence of community engagement, and finally, navigate the ever-evolving landscape of regulatory influences. This comprehensive approach is designed to give you a panoramic view of the forces at play, moving beyond simple price charts to understand the why behind the movements. Whether you're a seasoned investor looking to refine your analytical strategy and sharpen your decision-making process, or perhaps you're simply curious about the complex forces driving crypto prices on a global scale, this video is crafted for you. It promises to offer valuable insights that will help you decode the often intimidating crypto landscape. My goal is to empower you with knowledge, so you can approach your investment choices with greater confidence and clarity. So settle in, perhaps grab a notepad, and get ready for a comprehensive exploration that will equip you to make smarter, more informed investment choices in this exciting digital frontier. Alright, let's kick things off with the absolute cornerstone of any sound investment strategy, especially in the volatile world of cryptocurrency fundamental research. Think of this as building the foundation of a house. Without a strong, well-inspected base, everything else you build on top is at risk. When we talk about fundamentals in crypto, we're looking at the core elements that give a project its intrinsic value, or at least its potential for future value. This isn't about chasing hype or reacting to fleeting price spikes. It's about understanding the why behind a project's existence and its long-term viability. It's the detective work that separates informed investors from speculators. So, what exactly should you be looking for in a project's blueprint, often detailed in its white paper? The white paper is your primary document. It should clearly articulate the problem the project aims to solve. Is it a genuine, significant problem that a decentralized solution can uniquely address? Or is it a solution in search of a problem? A well-defined problem statement is the first green flag. Look for clarity, depth of understanding of the issue, and a compelling argument for why this particular crypto project is the answer. Vague problem statements or overly ambitious, world-changing claims without substance should raise immediate caution. Next, scrutinize the proposed solution. How does the technology work? Is it innovative, practical, and crucially, feasible? The white paper should delve into the technical architecture, the consensus mechanism, and the unique features that set it apart. You don't need to be a PhD in cryptography to get a sense of it, but look for coherence and detail. Alongside the what and how of the solution, pay close attention to the team behind the project. Who are they? What's their track record? Do they have relevant experience in blockchain, software development, business, or the specific industry they're targeting? Transparent, experienced, and committed teams are invaluable. The project's roadmap is another critical piece of the puzzle. This document outlines the project's development milestones, timelines, and future plans. A realistic, detailed roadmap shows that the team has a clear vision and a plan to execute it. Look for achievable goals and evidence of progress against past milestones. Are they consistently hitting their targets, or are there constant delays and excuses? Furthermore, consider any existing partnerships or integrations. Strategic alliances with established companies or other reputable crypto projects can lend credibility and open doors for adoption and growth, acting as a powerful validation of the project's potential. Beyond the white paper and the team, delve into the project's overall mission and vision. What is its long-term objective? Is it aiming to disrupt an existing industry, create a new market, or provide a niche service? Understanding the grander vision helps you gauge its potential impact and staying power. Also consider the competitive landscape. Are there other projects tackling the same problem? If so, what is this project's unique selling proposition, USP? How does it differentiate itself, and what are its competitive advantages? A thorough understanding here is key. Don't forget to look for evidence of a working product or at least a minimum viable product, MVP. Ideas are plentiful, but execution is everything. Has the team delivered anything tangible, or is it all still theoretical? The presence of an active GitHub repository with ongoing development, or a testnet mainnet launch, are positive signs. This shows commitment and the ability to translate concepts into reality. It's about separating the dreamers from the doers in this space, and a tangible product speaks volumes more than just a fancy website. Finally, fundamental research involves assessing the project's overall transparency and communication. Does the team regularly update the community on progress, challenges, and changes? Are they responsive to questions and concerns? A project that operates in the shadows or communicates sporadically should be viewed with skepticism. Openness builds trust, and trust is a vital component in the crypto ecosystem. By diligently examining these fundamental aspects, you're not just investing in a token, you're investing in a vision, a team, and a technology, building a much stronger case for its potential long-term value. Now that we've established the importance of fundamental research, let's shift our focus to market dynamics. These are the forces of supply, demand, and trading activity that directly influence a cryptocurrency's price and perceived stability in the short to medium term. While fundamentals tell you about a project's intrinsic potential, market dynamics reveal how the broader market currently values it and how easily it can be traded. Understanding these elements is crucial for navigating the often choppy waters of crypto trading and investment, helping you make more tactical decisions. First up, let's talk about liquidity. In simple terms, liquidity refers to how easily a cryptocurrency can be bought or sold without causing a significant change in its price. High liquidity is generally a positive sign. It means there are plenty of buyers and sellers, and you can enter or exit a position relatively smoothly. Key indicators of liquidity include trading volume, the total amount of the crypto traded over a specific period, and the number of reputable exchanges it's listed on. A crypto with high volume on major exchanges is far more liquid than one traded sparsely on obscure platforms. Low liquidity can be a red flag, leading to wider bid-ask spreads and price slippage. Next, we have market capitalization, or market cap. This is calculated by multiplying the current price of a coin by its circulating supply. Market cap is often used to gauge the relative size and stability of a cryptocurrency. Large-cap cryptos like Bitcoin or Ethereum generally have market caps in the tens or hundreds of billions, and are often perceived as more established and less volatile than their smaller counterparts. Mid-cap and small-cap cryptos offer potentially higher growth, but come with increased risk and volatility. It's a crucial metric for understanding a project's scale within the broader crypto ecosystem. Then there's the critical aspect of supply metrics: circulating supply, total supply, and maximum supply. Circulating supply is the number of coins actively available and trading on the market. Total supply includes all coins ever created minus any burned coins, including those locked or reserved. Maximum supply is the absolute cap on the number of coins that will ever exist for that cryptocurrency. Understanding these distinctions is vital. For instance, a project with a low circulating supply, but a very high total or max supply, could face inflationary pressure, as more coins are released into the market, potentially diluting the value of existing holdings. The interplay between these supply metrics and demand is what fundamentally drives price. If demand for a cryptocurrency increases while its supply remains constant or decreases, perhaps through coin burns, the price is likely to rise. Conversely, if supply outpaces demand, the price may fall. This is basic economics, but it's amplified in the crypto space due to the transparency of supply schedules for many projects. Always investigate how new coins are introduced into circulation, through mining, staking, or pre-scheduled releases, as this directly impacts inflationary or deflationary pressures. Trading volume, which we touched on with liquidity, also provides insights into market sentiment and interest. A sustained increase in trading volume alongside a price rise can indicate strong buying pressure and validate an upward trend. Conversely, high volume during a price drop might signal significant selling pressure or panic. However, be wary of wash trading, artificial volume created by entities trading with themselves to feign activity, especially on less regulated exchanges. Always cross-reference volume data across multiple reputable sources to get a clearer picture. Market sentiment, while also covered in a later chapter in detail, plays a significant role in short-term market dynamics. News events, social media trends, influencer opinions, and general investor optimism or fear can cause rapid price swings, sometimes detached from a project's fundamentals. Tools that analyze social media sentiment or track fear and greed indices can offer a glimpse into the prevailing mood, but these should be used cautiously and in conjunction with other forms of analysis. The herd mentality can be a powerful yet often irrational force in crypto markets. Finally, consider the overall market cycle. The cryptocurrency market, much like traditional markets, tends to move in cycles of boom and bust, or bull and bear phases. Understanding where we might be in a broader market cycle can influence your strategy. During bull markets, even weaker projects can see price appreciation, while bear markets tend to expose vulnerabilities. Recognizing these larger patterns, often through technical analysis of historical price charts and market indicators, can help you contextualize current market dynamics and manage expectations for a particular cryptocurrency's performance. Alright team, let's get a bit more technical and explore the engine that powers every cryptocurrency, its underlying technology. This is where we delve into the blockchain protocols, scalability solutions, and security aspects that are absolutely fundamental to a project's functionality, resilience, and long-term prospects. A fancy marketing campaign or a charismatic founder can only take a project so far. If the technology is flawed, insecure, or unable to scale, it's ultimately built on shaky ground. Understanding these tech elements is key to assessing if a project can deliver on its promises. First, let's consider the core blockchain protocol itself. Is it a proof-of-work POW system like Bitcoin, which relies on miners solving complex computational puzzles? Or is it a proof-of-stake POS system like Ethereum, post-merge, where validators stake their own coins to secure the network? Each consensus mechanism has its own trade-offs regarding security, energy consumption, decentralization, and transaction speed. Understanding the chosen protocol and why it was selected for that specific project's use case is a critical starting point. Some projects even use novel or hybrid consensus mechanisms, which require even deeper investigation. Scalability is a massive talking point in the blockchain space, and for good reason. As a network grows and more users conduct transactions, the ability to handle increasing load without compromising speed or cost becomes paramount. We've seen popular blockchains get congested, leading to slow transaction times and exorbitant fees. So investigate the project's scalability solutions. Are they implementing layer 2 solutions like rollups or state channels? Are they exploring sharding, where the database is split into smaller, more manageable pieces? A clear and viable plan for scaling is essential for any project aiming for mass adoption. Security is non-negotiable. The history of crypto is unfortunately littered with hacks, exploits, and vulnerabilities that have resulted in catastrophic losses. Therefore, you must scrutinize the security measures in place. Has the project undergone independent security audits from reputable firms? Are these audit reports publicly available, and have any identified vulnerabilities been addressed? What mechanisms are in place to prevent common attack vectors like 51% attacks, especially for smaller POW chains, or smart contract exploits? A proactive and transparent approach to security is a hallmark of a serious project. Smart contract functionality, if applicable to the project, is another area to explore. Smart contracts are self-executing contracts with the terms of the agreement directly written into code. They are the backbone of decentralized finance, DeFi, NFTs, and many other blockchain applications. If a project relies heavily on smart contracts, assess their complexity, efficiency, and again, their security. Flaws in smart contract code are a primary target for hackers. Look for projects that use formally verified code or have rigorous testing processes for their smart contracts. Interoperability is also becoming increasingly important. This refers to the ability of different blockchain networks to communicate and exchange information or assets with each other. In a multi-chain future, projects that can seamlessly interact with other ecosystems are likely to have a significant advantage. Does the project have plans for cross-chain bridges or compatibility with standards like IBC, Inter-Blockchain Communication Protocol? Siloed blockchains may find themselves isolated, limiting their utility and reach. The future is collaborative, and tech that supports this will thrive. Consider the development activity and the strength of the developer community around the project. An active GitHub repository with frequent commits, updates, and contributions from multiple developers is a healthy sign. It indicates ongoing improvement, bug fixing, and innovation. Conversely, a stagnant codebase or a project overly reliant on a single developer can be a risk. A vibrant open-source community not only contributes to the code, but also helps with testing, documentation, and overall ecosystem health, making the project more resilient. Lastly, look at the overall technological innovation and uniqueness. Is the project bringing something genuinely new to the table, or is it merely a copycat of existing technologies with minor tweaks? True innovation is harder to find, but often leads to more sustainable value. Does the technology solve a problem in a significantly better way than existing solutions, whether centralized or decentralized? A project that pushes the boundaries of what's possible with blockchain technology while maintaining security and a path to scalability is one that warrants serious attention from a tech perspective. Chapter 4: The Economic Engine, Decoding Tokenomics. Now let's dive into one of the most crucial yet often misunderstood aspects of evaluating a cryptocurrency, its tokenomics. Tokenomics, a portmanteau of token and economics, refers to the science of a cryptocurrency's economic model. It dictates how a token is created, distributed, managed, and what utility or rights it confers upon its holders. A project can have groundbreaking technology and a stellar team, but if its tokenomics are poorly designed, it can severely hinder its long-term success and value accrual. It's the internal economic engine driving the crypto. First and foremost, examine the token's supply model, which we touched upon earlier but deserves a deeper look here. Is there a fixed maximum supply like Bitcoin's 21 million coins, creating inherent scarcity? Or is it an inflationary model where new tokens are continuously created, potentially for staking rewards or funding development? If it's inflationary, what is the inflation rate, and is it sustainable? Some tokens have deflationary mechanisms, such as transaction fee burns, which reduce the total supply over time. Each model has implications for value. Scarcity can drive up price if demand is high, while controlled inflation can incentivize participation. Next, how was the token initially distributed, and how is it allocated now? Was there a pre-mine for the team and early investors? If so, what percentage of the total supply do they hold, and what are their vesting schedules? Large unvested allocations to insiders can pose a risk if they decide to sell off their holdings en masse, crashing the price. A fair and transparent distribution model that aligns the incentives of the team, community, and investors is crucial. Look for detailed breakdowns of token allocation to development, marketing, community incentives, ecosystem funds, etc. The utility of the token is paramount. Why does this token need to exist? What can you actually with it within the project's ecosystem? Does it grant governance rights, allowing holders to vote on proposals? Is it used to pay for transaction fees or access specific services? Can it be staked to earn rewards and secure the network? A token with strong, clear, and indispensable utility is more likely to see sustained demand. If the token's primary use case seems forced or non-essential to the platform's function, its long-term value proposition is questionable. Incentive structures are a core component of tokenomics. How does the project encourage users to acquire, hold, and use its tokens? Staking rewards are a common incentive, encouraging long-term holding and network participation. Liquidity mining programs incentivize users to provide liquidity to decentralized exchanges. Airdrops can be used to bootstrap a community or reward early adopters. Well-designed incentives can create a positive feedback loop, driving adoption and network effects. However, overly aggressive or unsustainable incentive programs can lead to token hyperinflation and subsequent price collapse once the incentives dry up. Mechanisms like token burns or mints directly impact supply and therefore potential value. Token burns permanently remove tokens from circulation, often by sending them to an unrecoverable address. This is a deflationary measure that can increase scarcity and potentially drive up the price of remaining tokens, assuming constant demand. Conversely, minting involves creating new tokens, which is an inflationary action. Understanding if, when, and why tokens are burned or minted is vital. Is it a regular programmed event, or is it at the discretion of the team or a DAO? Consider the governance model associated with the token. In many decentralized projects, token holders are given the power to propose and vote on changes to the protocol, treasury allocations, or other key decisions. This gives the community a stake in the project's future and can foster a sense of ownership and engagement. A well-structured governance framework can make a project more adaptable and resilient. However, it's also important to assess the distribution of voting power. If a few large holders control most of the votes, the governance might not be truly decentralized. Finally, analyze the overall economic sustainability of the token model. Does it create a balanced ecosystem where all participants, users, developers, investors, validators, are appropriately incentivized and rewarded? Does the model have mechanisms to fund ongoing development and maintenance of the project without relying solely on continuous token sales? A tokenomic model that is self-sustaining and designed for long-term growth is a sign of a mature and thoughtfully planned project. Poor tokenomics can be a silent killer, so due diligence here is absolutely essential for any investor. Chapter 5. The Power of People, Community, and Market Sentiment. Beyond the code and the economic models, there's a powerful, often intangible force that significantly influences a cryptocurrency's trajectory, its community, and the prevailing market sentiment. In the crypto world, a project is often only as strong as the community backing it. An active, engaged, and supportive community can drive adoption, provide valuable feedback, contribute to development, and act as passionate advocates. Conversely, a toxic or disengaged community can be a major red flag. Let's explore how these human elements shape crypto value. The size and activity level of a project's community across various platforms like Twitter, Telegram, Discord, Reddit, and forums are key indicators. Are discussions vibrant and constructive? Are new members joining regularly? A large and growing community suggests increasing interest and potential network effects. Look for genuine engagement, not just a high follower count, which can sometimes be inflated by bots. Quality of interaction often matters more than sheer quantity. Are people helping each other, discussing use cases, and contributing ideas? Developer community engagement is also crucial, especially for open-source projects. An active group of developers contributing to the codebase, building tools, or creating third-party applications on top of the platform is a very healthy sign. This indicates that the technology is not only functional, but also inspiring others to build with it. Check the project's GitHub repository for activity, look for developer forums, and see if hackathons or grants are offered to encourage building within the ecosystem. A thriving developer ecosystem expands the project's utility and resilience. User adoption is the ultimate validation of a project's value proposition. Are people actually using the cryptocurrency or platform for its intended purpose? Look for metrics like the number of active wallet addresses, transaction counts, or if it's a dApp platform, the number of active users on applications built on it. Real-world usage drives demand for the token and demonstrates that the project is solving a tangible problem or providing a valuable service. Without user adoption, even the most technologically advanced project can falter. Market sentiment, which is the overall attitude or feeling of investors towards a particular cryptocurrency or the market as a whole, can be a powerful short-term driver of price. Positive sentiment, often fueled by good news, successful product launches, or influencer endorsements, can lead to buying pressure and price increases. Conversely, negative sentiment, perhaps due to bad news, security breaches, or regulatory FUD, fear, uncertainty, and doubt, can trigger sell-offs. While sentiment can be fickle, it's an important factor to monitor. Social media plays an enormous role in shaping and reflecting crypto sentiment. Trends on Twitter, discussions on Reddit, and videos from YouTube influencers can significantly sway opinions and trading behavior, especially among retail investors. It's important to be discerning though. Hype and shilling are rampant. Try to gauge the of sentiment. Are discussions balanced, or is it an echo chamber of uncritical praise or relentless negativity? Look for reasoned arguments and diverse viewpoints rather than just emotional outbursts. Media coverage also contributes to market sentiment. Positive mentions in mainstream financial news or reputable crypto publications can boost a project's credibility and attract new investors. Conversely, negative press can damage its reputation. Analyze the nature of the coverage. Is it in-depth and analytical, or superficial and sensationalist? Consistent, positive, and factual media presence is generally a good sign, indicating that the project is making noteworthy progress or has captured significant interest. Finally, the project team's interaction with its community is vital. Are they transparent in their communications? Do they actively engage with community members, answer questions, and address concerns? A team that fosters a strong, positive relationship with its community is more likely to build loyalty and resilience, especially during challenging market conditions. Regular updates, AMAs, Ask Me Anything sessions, and responsiveness demonstrate commitment and respect for their supporters. This two-way communication is key to building a lasting and vibrant ecosystem around any crypto project. Chapter 6: Navigating the Maze. Regulatory and Risk Factors. Our final chapter focuses on two critical intertwined aspects that can profoundly impact a cryptocurrency's long-term viability and market perception: the regulatory landscape and inherent risk factors. The crypto space is still relatively young, and the rules of the road are constantly evolving across different jurisdictions. Understanding how government policies and various risks can influence a project is essential for making informed, cautious investment decisions and for managing your overall portfolio exposure. Ignoring these can lead to unpleasant surprises down the line. The regulatory environment for cryptocurrencies varies dramatically from one country to another. Some nations have embraced digital assets, providing clear guidelines and fostering innovation, while others have imposed strict restrictions or outright bans. Changes in regulation, or even just the anticipation of such changes, can cause significant market volatility. It's crucial to stay informed about the regulatory stance in key markets relevant to a specific project, such as where its team is based, where its primary users are, or where it aims to operate. Projects that proactively engage with regulators and strive for compliance are often better positioned for long-term stability. Key regulatory concerns often revolve around investor protection, anti-money laundering, AML, and countering the financing of terrorism, CFT, requirements. Projects that operate exchanges or offer financial services are typically subject to more stringent scrutiny. The classification of a token, whether it's deemed a security, a commodity, or a utility token, also has significant regulatory implications, affecting how it can be traded, marketed, and who can invest in it. The lack of clear, harmonized international regulations adds a layer of complexity and uncertainty for many crypto projects. Beyond regulatory risks, there are numerous other risk factors inherent to the crypto space. Technological risks, as we discussed earlier, include smart contract vulnerabilities, network exploits, or failures in the underlying blockchain. Security breaches can lead to substantial losses of funds and a severe blow to a project's reputation, from which it may never recover. Diligence in assessing a project's security audits and practices is therefore paramount. Never assume any system is unhackable. Always consider the potential for technological failure or malicious attack. Market risk is another significant factor. Cryptocurrency prices are notoriously volatile, subject to rapid and unpredictable swings. This volatility can be influenced by macroeconomic factors, changes in market sentiment, liquidity issues, or even actions by large holders, whales. Investing in cryptocurrencies means accepting a higher degree of price risk compared to many traditional assets. It's vital to only invest what you can afford to lose and to understand that past performance is not indicative of future results. The potential for sharp downturns is always present. Project-specific risks also need careful consideration. These can include issues with the team, such as a lack of experience, internal conflicts, or even fraudulent behavior. Failure to deliver on roadmap promises, an inability to achieve product-market fit, or intense competition can also derail a project. The failure rate for startups in general is high, and this is no different in the crypto space. Thorough due diligence into the team, their execution capabilities, and the competitive landscape can help mitigate some of these risks, but they can never be eliminated entirely. Finally, risk management is a personal responsibility for every investor. This includes diversifying your crypto holdings rather than putting all your eggs in one basket, using secure wallets and practicing good operational security, like strong passwords and two-factor authentication, and staying informed about the projects you invest in. It also means having a clear investment strategy and exit plan. Don't let FOMO, fear of missing out, or FUD drive your decisions. A disciplined, well-researched approach, coupled with an understanding of the potential downsides, is crucial for navigating the crypto market successfully and sustainably. Outro your crypto compass, making informed decisions. To wrap up, selecting the right cryptocurrency or even deciding whether to invest in the space at all isn't about relying on a single metric or a hot tip. As we've explored today, it's a holistic evaluation where a multitude of factors, robust fundamentals, prevailing market dynamics, resilient technology, sound tokenomics, vibrant community sentiment, and the ever-present regulatory factors, all play pivotal, interconnected roles. Each of these elements contributes a unique thread to the overall tapestry of a cryptocurrency's perceived and potential value, and understanding their interplay is key. Each of these elements we've discussed interconnects, painting the overall picture of a cryptocurrency's current state and future prospects. For example, strong technology can attract a dedicated community, which in turn can positively influence market dynamics. But all of this can be impacted by an unfavorable regulatory shift. By taking the time to diligently understand these various aspects and, more importantly, how they interact with one another, you're equipping yourself to better analyze market trends, identify genuine opportunities, and ultimately make more informed, confident investment decisions in this dynamic asset class. Remember, there's no guaranteed path to success or riches in the crypto world, and anyone promising otherwise should be met with extreme caution. However, a thorough, diligent research approach, combined with a healthy dose of cautious optimism and robust risk management, are undoubtedly your best tools for navigating this exciting but often challenging landscape. If you found this deep dive helpful and it provided you with some valuable insights, please give this video a thumbs up, subscribe for more in-depth crypto insights, and don't hesitate to drop your questions, thoughts, or even your own experiences in the comments below. I love hearing from you. Thanks for watching, and here's to making smart, informed crypto decisions. I look forward to seeing you all on my next video where we'll break down more aspects of crypto investments. As always, remember this video is not financial advice, so please make sure you do your own thorough research. See you on the next video.